All right, well, welcome back to the Trip and RCHR NeighborWorks Homeownership Center's online orientation. This is part two of the three-part series. In this part, we're going to talk more about what are the basic requirements for getting a mortgage, what are lenders looking for, and what my next steps are going to be. A lot of times, a conversation that I have with my clients is the comparison between their rental payments and their mortgage payments. A lot of times, we'll say, hey, well, if we're paying eight, $900, $1,200 in rent, of course I can pay that in mortgage payment as well and actually have it be an investment for my future. Well, first, let's make sure we're looking at what that mortgage payment might include. The principal, interest, taxes, and insurance. This is called your pity payment. It's a pity to have to pay it. That's one way to remember every month that this is going to be your pity payment. Well, in that pity payment, again, that's your principal, interest, taxes, and insurance. But that doesn't include things like utilities, garbage removal, water bills, having to save for maintenance on your home and future expenses. So again, when we're looking at the cost of homeownership, sure, that mortgage payment might be the same as what your rent might have been, but let's make sure we're considering all those other new costs that are going to come with it. Additionally, when we're at the end of our lease, we have the ability to pick up our household and move it to somewhere else that we prefer. We want to go to a different school district. You don't really have the ability in a house to pick up that house and move it to that new school district. So we really want to make sure that we are thinking about all these options and we're thinking about all these benefits of renting prior to just jumping into thinking homeownership is right for us. Maybe you're in the position that you're not financially ready to own, or your credit's not quite where a lender might want to see it. Again, those might be reasons why renting is better than homeownership. But let's talk about the benefits of homeownership as well. Homeownership brings stability for both you, your household, your children. Sometimes people want to purchase houses because of possible income tax benefits. For that one, make sure you're checking back in on an annual basis as those benefits change. Additionally, a really great reason to want to purchase a house is to be able to have future equity and future investment. For example, if you're purchasing a $100,000 house but only need to take out an $80,000 mortgage, or maybe only have an $80,000 mortgage remaining, then you will have a $20,000 investment in your equity, which is $20,000 that can help you for any future needs. So now let's think of some reasons why homeownership might be the right option for you. Sometimes there are income tax benefits that you might receive, but again, that changes on a regular basis, so you always want to refer back to rules and regulations. Homeownership gives you the ability to build equity or investment into your property. Additionally, homeownership gives you the ability and freedom to control your environment. If you want to paint your walls bright green, you can in your home. Sometimes with a rental, you don't even have the ability to put up pictures, which I'm sure you're aware of. So now that we've looked at the pros and cons of homeownership, let's talk about the steps in the process to getting that mortgage. Well, we see here there are 10 steps, easy 1 through 10, to get you through that home buying process. It would be easy to look at this and say, oh, 10 easy steps. It's like HGTV. I'm going to be done in 30 minutes. But in reality, we know that there's a lot more to buying a house than just these 10 steps. So that's where you want to sit with your counselor and talk about your specific steps and what additional steps you might need to take to get yourself into that home. But let's talk about what a lender's going to look at. Most of us don't have $100,000 sitting in our back pocket to be able to purchase that house. So then we need to find a way to borrow it. And here you will see 3 typical avenues to borrow this money. In addition to what you see here, please keep in mind that a lot of our local lenders have really great programs for first-time home buyers. Just another reason you want to sit down with your counselor to talk about which loan products are out there and what fits your needs best. So here you're going to see a categorization of different types of loan products and who runs and regulates them. You'll see that we have conventional loan programs, which are typically funded by the private sector, like Freddie Mac and Fannie Mae. We have New York State programs, like Sunny Mae, State of New York Mortgage Agency. We have federal government programs like FHA, USDA, and VA. And additionally, we're going to have loan programs that a lot of our local lenders have created for first-time homebuyers specifically. This is another reason why you want to check back with your counselor to figure out which loan product is best for you. When I talk about conventional, New York State, or federal government, those are just the people who set the rules and regulations for those different loan programs. When I talk about loan programs, I kind of like to compare them to different types of cakes. Whether it's an ice cream cake or a double chocolate cake or a red velvet cake, you want to look at the ingredients of those cakes to figure out which is the most appetizing one for you. Well, you're going to want to do the same thing for your loan products. So you're going to want to look at each of those ingredients, whether it's a Fannie Mae program or Sunny Mae or FHA. You want to look at their ingredients and their requirements to figure out which one is the most appetizing to you, which one makes the most sense and is the least expensive. That's something you're going to do one-on-one with your counselor. You're going to go over things like what are each of the loan product requirements for down payment, for credit scores, for out-of-pocket requirements, and so on. Once you've decided what kind of cake or maybe what loan product you're going to get, we also want to look at the 4 C's of credit. That's the next requirement that lenders are going to look at. Lenders are going to look at cash, credit history, capacity, and collateral. You'll see 3 items listed here. That fourth one, collateral, that's a conversation that you and your counselor are going to have so that way we can coach you on how to look for a house that is worth the amount of loan that you're looking to borrow. All right, so cash. A lender is going to look at your savings, your gifts, your seller's concession to make sure that you have enough cash for the entire transaction. For credit history, a lender is not going to just look at your credit score, but they're going to look at the full credit history on how you pay back your debts. They want to know that at the first of the month, every single month, you're likely to pay them back on time every month. Typically, around here, lenders want to see around 640 or 660 or higher to qualify for most loan programs. The higher your credit score, the better opportunities you will have for loan programs. Additionally, aside from mortgages, the higher your credit score, the best interest rates you're going to get out there. You know those APRs, those low interest rates, sometimes 0% financing, those best interest rates that are advertised out in the market are typically for people who are around 740, 760 or higher. You want to make sure you're very familiar with your credit history and credit score. You want to make sure that you're checking every single year, if not twice a year, your credit report. You can get a credit report for free from annualcreditreport.com from each of the credit bureaus. You will have to pay for your credit score, but you can at least get the credit report for free. When you go to move forward with our homeownership center, we will be pulling your credit report to help direct your next steps. The credit report that we will be pulling is going to be a soft pull. It will not affect your credit score, but it will have a tri-merge credit summary and credit score, which will be very similar to what lenders are looking at. The third C, which is capacity, also looks at stable income. Lenders want to see that you typically have 2 years or more of full-time income. All right, well, let's dive a little bit further into cash. So again, lenders want to see that you have enough assets for the entire transaction. Do you have enough for all these items listed? Down payment, upfront costs, closing costs, which are typically $7,000 to $10,000, and then reserves. After you spend all this money, lenders want to see that you still have at least 1 to 2 months of mortgage payment left aside in your savings account. Here's an example of how those different ingredients of the loan products can affect our purchasing process. So here we see different examples of down payment options. FHA, conventional, Sunny Mae, VA, and USDA all have different down payment requirements, and you want to know what is expected that you have to pay for closing. An FHA loan requires 3.5% of the loan amount for closing. So on a $100,000 loan, 3.5% would be $3,500. One thing that you also want to look at when we're looking at down payment requirements is the minimum contribution required out of pocket. For example, FHA does require 3.5% for down payment, but none of that is required to come out of pocket. It can come from gifts, grants, or seller concessions. Similarly, Sunny Mae requires 3% total down payment typically, with only 1% required out of pocket. So in that example, for a $100,000 purchase price, they would require 3% total down payment, but only $1,000 of that would have to come from your bank account. So again, just another example as to why we want to make sure we're looking at all those ingredients and all those different loan products to find which works best for us. Now, upfront costs. Upfront costs have the ability to add up fast. As you can see, there's a series of 5 items listed right here, all things that you will need to have cash for when it comes time for purchase. Your good faith deposit on the contract is kind of like you calling dibs on that house. It's typically about $1,000 or 1% of the amount of the loan. Home inspections are typically range from $450 to $600. Please keep in mind though, that if you need to have surveys or additional inspections, that price is going to certainly increase. Homeowners insurance is expected to be paid upfront at the time of closing for a full year. So we want to make sure we're taking that amount into consideration as well. You can see how quickly upfront costs can add up. If our good faith deposit was $1,000, our home inspection $500, application fee and home insurance, altogether that already equals $2,600. This right here shows you that there's no way to get into a home without putting some cash down. Now let's total everything up. So if our upfront cost was $2,600, our down payment was $3,500, and our closing costs, let's estimate $8,000. Right there, that's $14,100 we need for the purchase of a house. This is why it's important to make sure you're talking with your counselor. We can talk about, well, can we get those costs down? How much cash do you need to have out of that $14,100? We want to help prepare you for your next financial steps for success. All right, that next C that we're going to talk about is capacity. So in addition for lenders looking for 2 years of full-time employment, they also are going to look at different ratios of your gross monthly income to determine how much of a mortgage payment you can actually qualify for. The two ratios that they're going to look at are housing ratios and debt ratios. Keep in mind that both of these ratios look at gross monthly income. It's not really what you're taking home. So we want to keep that in mind when we're talking about how much can we actually afford. Again, this is how lenders will calculate your affordability. That does not mean that's actually what you can pay out of pocket because this is gross money. It's before any taxes or any debts are taken out. So at the bottom of this screen, you see another chart, again listing those same loan programs. This is demonstrating there's just one more ingredient that we want to take a look at. Now, the examples that I'm giving you today are just a few of all the ingredients of each of these loans that we want to make sure we're taking into consideration before we decide what's the best one for us. We're going to use FHA again just to keep it similar across the board. So for this example, FHA requires 31% over 43%. What does that mean? Well, the top number is the housing ratio. The 31% for FHA, conventional is 28, Sunny Mae 40, VA 41, and USDA 29. That top number is the housing ratio, or the percentage of your gross monthly income that is allowed for your monthly mortgage payment. And again, this mortgage payment is going to be that PITI payment, the principal, interest, taxes, and insurance. Now that bottom number, that debt ratio number, which is 43 for FHA, 36 conventional, Sunny Mae is 45, VA is 41, and USDA is 41. That bottom number, that debt ratio number, is the percentage of your gross monthly income that the lender will allow, plus any monthly minimum debt obligations that show up on your credit report. Additionally, any alimony or child support. So what does that mean? That means for FHA, they will allow 31% of your gross monthly income for just your debts. But since most people have debts, they're going to allow up to 43% of your gross monthly income for both your monthly minimum mortgage payment and those debt obligations. Let's go to the next slide to see what that means. All right, so here are our FHA ratios of 31% over 43. Let's put that into some real numbers. In this example, this client makes $37,000 a year. If we divide that by 12, that would give us a gross monthly income of $3,083.33. Now again, that housing ratio, that top number, which is 31%, is going to be the amount that we would be allowed to use for our mortgage payment. So if we take $3,083.33 and multiply that times 31%, we are left with $955.83. Over to the left here, we see that we have some debts listed. So this person has $151 a month that they pay for auto loans and $50 a month that they pay for student loans. Combined, that is a total monthly debt obligation. And again, these are only the minimum payments that are paid, or the minimum required payments. So it's a total monthly debt obligation of $201. We need to use that in our debt ratio. So again, the debt ratio is the maximum amount that is allowed for both your monthly mortgage payment, which is your PITI, P, principal, interest, taxes, and insurance, and the minimum payments on your credit report, alimony, and child support. So in this scenario, they take $3,083.33. They multiply that times 43%. That gives a total of $1,325.83. You will then subtract out that $201 a month that they pay for minimum monthly debt obligations to get a total of $1,124.83. Then a lender will look at those two numbers and take the lower of the two ratios because again, this is gross income. This is not really what we're taking home each day. So in this scenario, the lender will say, okay, the maximum mortgage payment that this person can qualify for is for $955.83. Keep in mind that each lender might take into consideration compensating factors, such as maybe a large down payment, a large amount of reserves, great credit score. These are all up to the lender's discretion, and I encourage you to have that conversation to see if they're plausible. In this next example, we will see that Sunny Mae ratios are being used. So the only difference between the one that we just saw and this slide are the different ratios. Sunny Mae allows 40 over 45%, where FHA allows 31 over 43%. So the same income is used, the same debts are used. So in this scenario, our housing ratio is 40%. We multiply 40% times $3,083.33 to get $1,233.33 for the maximum mortgage payment if we didn't have any debt. But again, we do have debt, and they always do that debt ratio calculation. So the 45% times $3,083.33 equals $1,387.50. Again, we subtract out that $201 monthly minimum obligation to get a monthly mortgage payment of $1,186.50. In this scenario, again, because they look at the lower of the two values, the maximum mortgage payment that this person could qualify for is $1,186.50. In this slide, you're going to see the difference between the two. So now we're just comparing. With Sunny Mae ratios, 40 over 45%, this client could afford a monthly mortgage payment of $1,186.50. For FHA ratios, 31 over 43%, this person can qualify for a maximum monthly mortgage payment of $955.83. This is just demonstrating why it is so important to make sure you're sitting down with your counselor to figure out which is the best loan product for you. At the end of the day, regardless of what the lender says you can afford, you also want to have that conversation about what can you really afford. Just because the bank says I can purchase a $400,000 loan, can I really afford to pay for that $400,000 loan? Well, this is the same thing. Just because Sunny Mae says I can pay every single month $1,186.50, you need to have that conversation and say, well, can I really? Can I really pay that amount of money each month, plus all those other debts that come with it, plus the increase in utilities, plus the water bill and the garbage removal bill, and saving for maintenance? This is why it's so important to have that counselor to have that conversation with. All right, folks, well, that wraps up part 2 of our 3-part series. Make sure that you move on to that third and final presentation, and then after that presentation, fill out that questionnaire and start those next steps. Thanks so much.